Well, first of all, Happy New Year, everyone.
What's happy about
From Los Angeles. It's been rain. It's been a rainy holiday season, so I'm sure that'll make you happy. We didn't have sunshine. Been one of the rainiest starts to the quote unquote water year here in LA since I think 2004. I remember 2004 fondly. The Fed was bringing interest rates up from a 1% floor, I believe, in mid to late 2004. So So anyway, but what should we be focused on? Probably not ISM. I mean, I think ISM manufacturing has been weak for some time.
Yes.
Definitely tariffs are not helping. But it's a bigger story than that. So that's probably not the main event that we're watching. For us, probably the main event is I still think everyone is missing the fact that inflation could moderate more than anticipated. So I think a lot of clients, not to pick on clients by any means, but a lot of colleagues, I'll pick on some colleagues, worried about inflation just being stuck at 3%, Tom, or accelerating. Those are the main topics of conversation. And we really think, the Payden economics team thinks we could get back to 2% sometime later this year. And so I think that'll be an interesting story because that will matter the most for the bond market, as you know. That'll be the real key story, not ISM. I'm sorry to the purveyors of the ISM.
Okay.
So what would cause maybe inflation to moderate a little bit more than the market's thinking about, Jeffrey?
Yeah, we always think about, the three buckets for core inflation. So, the tariff story, I think that's sort of behind us. Last year, big narrative for clients was that tariffs were going to cause a lot of inflation. That has not happened, and we think goods prices could moderate this coming year. So that helps. Then non-housing services. You have a soggy labor market. You have a weak labor market. You have an unemployment rate at 4.6%, maybe a little bit higher as the year goes on. That should feed through into softer non-housing services. So I think that's important. And then the big sticky component of core inflation, as you know, has been housing, has been the shelter component. We see scope for that to continue to cool off in 2026. So those are your three big components, and all of them, we see some moderation activity there. So you do the math. You do a little bit of math, here at 6:40 in the morning in LA, you can get a 2% year-on-year rate of core PCE, which is the Fed's target. And even if we're 2.2, 2.3, that's great news for the Fed.
I don't think that's in the market. I don't in the zeitgeist. I'm talking tenths of a percent. 2.0% isn't in the market.
No, I think Jeffrey was right. I think the consensus is kind of sticky here at 3 or maybe even a little bit higher here. On the other side of the equation for the Federal Reserve is the labor market, Jeffrey. What's your read there?
Well, I hope the optimists are right. The optimists on Wall Street right now are saying that, we have some residual seasonality here with the payroll data. It was weak last year, in 2024, leading into 2025, we saw things pick back up. So I think there is some expectation. You see that in the Bloomberg consensus, I think for Friday, the payrolls are going to be positive. The unemployment rate could tick down. I hope that's right. Our sense, though, is just looking at the history of the payroll series. It's pretty rare for job growth to slow as much as it has and then reaccelerate.
Right.
Mid-90s, you had a bit of that. So it's possible, but it's more likely that job growth remains slow and the unemployment rate rises a bit this year, which again, that coupled with moderated inflation leads to Fed cuts. That's the punchline.
Jeff, let me squeeze this in before we have to go to really important matters. But Jeffrey, I look at Jobs Day on Friday and I'm old school where sub 100,000 isn't a good number. Tell me I'm wrong. I'm supposed to be happy with a sub 100,000 non-payroll statistic?
I'm with you. Sub 100,000 is not good. But what is the optimistic case that I've heard? Well, people tell me the break-even rate of job growth is lower. What do I mean by that? We don't need as many jobs every month because we have a shrinking labor force, and that can keep the unemployment rate. I don't buy that. I don't buy that for a second. For me, weak payroll growth is weak payroll growth. That will eventually feed through into weaker consumer income growth, and that will eventually feed through into softer consumer spending. So I come down on a little more on the pessimistic side of that payroll slowing.